The International Monetary Fund, IMF, has raised serious concerns over Bangladesh's banking sector, questioning why loss-making banks continue to pay salaries and bonuses to staff despite mounting losses and rising non-performing loans (NPLs). This issue came to light during a meeting between an IMF delegation and Bangladesh bank officials, where the IMF representatives asked why financially distressed banks with high NPLs and significant capital deficits were not being liquidated. Bangladesh bank officials responded that liquidation is rare in the country, and instead, 5 banks have been placed under a merger initiative, while others are implementing capital restoration plans. However, IMF officials expressed doubt about the effectiveness of these prolonged recovery plans, urging Bangladesh to define a clear path for either restructuring or liquidation. Rising capital shortfalls in the banking sector have exceeded TK 1.55 lakh crore by the end of June 2025, with 24 out of 61 scheduled banks failing to maintain the mandatory minimum capital requirement. Central bank officials claimed that no newly issued loans had defaulted in the past year, but the current wave of defaults stems from loans issued during the previous government's tenure. In a separate meeting, IMF officials discussed the state of the foreign exchange market with Bangladesh Bank Governor Ahsan H. Mansoor, noting that Bangladesh's exchange rate regime still did not reflect a fully free-floating market. Governor Mansoor rejected this claim, stating that the market is free-floating with no intervention. The IMF delegation also raised observations regarding Bangladesh's new loan rescheduling policy and the absence of a cooling period for rescheduled loans, suggesting that restructured loans should not be classified as performing immediately. Bangladesh bank officials acknowledged the absence of such provisions, but argued that the country's lending policies toward defaulters are already stricter than those of many other nations.